Good morning, everybody. Happy Tuesday. I hope you guys are all having a good start to the week. This week is certainly a much better start than what we saw 2 weeks ago when we're talking about the markets. This is the Merkle Market Update. I'm Lauren Merkle, owner of Merkle Retirement Planning. Welcome. What our goal is with these Merkle Market Updates is to give you a little bit different information than what you're hearing on the news. There's a lot of great information that's out there, whether you log on online or you watch the business channels, but our goal is to give you some more actionable items. What I think is we're just kind of hitting this perfect storm. And what I mean by that is most of us are kind of confined to our homes. We're not able to go outside very much and live our normal lives, so we're watching more TV than ever. And especially starting about a couple weeks ago, we were watching TV and we were watching our 401k plans, watching our IRAs drop in a precipitous way that really we haven't seen since the Great Depression. And what you're hearing today is that we've had the worst month from a stock standpoint, a stock performance standpoint, since the Great Depression. And we're also hearing that the Dow hasn't performed this poorly since 1987. So we're really seeing some volatility, some market movements that we haven't seen in a very long time. In fact, some of us have never seen it. So the question is what can you do during these time frames? One of the pieces of feedback that we hear every single time that we go through a market downturn like we're seeing right now is do nothing. Do absolutely nothing. Close your eyes, put your head in the sand, and then we're going to wake up sometime 12 months, maybe 2 years from now, and our portfolios are going to be back to even and everything's going to be fine. Well, some of that I agree with. But when we see opportunities like this that we can enhance our situation, now what I'm not talking about is I'm not just talking about selling out. So when you hear feedback like do nothing, that's what they're saying. Don't just rush to cash, don't panic, don't go to cash, because then you're not going to be able to take advantage of the market on the way back up. That conceptually is true, but there are some exceptions to every rule. So one of the concepts I'm going to talk about today is when does it make sense, when might it make sense to sell some of the positions that you have and make a change so when this market does come back up, you're going to be in an even better position going forward. Now, after last week's Facebook Live, we received a number of questions. I do want to cover 2 of those questions today. If you have some questions that you've been thinking about, questions that this Facebook Live spurs, go ahead and message us those questions, and then next week I'll try to address as many questions as I can. From last week, 2 questions that we received. The first one, is the federal relief stimulus, the checks that we're going to receive, is that taxable? So the $1,200 check if you're single, the $2,400 check if you're married, is that considered taxable income? The answer to that is no. So that's good news. So that's a net $1,200, a net $2,400 that you will be able to use right away to help you with your bills and your situation. The next question, a little bit more complex, but I think it's a great question, and we always hear this question, especially in these times of volatility. Is gold a good investment? Should we be diversifying a portion, or sometimes people ask all of my portfolio, into precious metals, specifically gold? Now, the answer to that question is, first of all, I think it's a really good idea to have a truly diversified portfolio. All the time we're talking about how do you create recession-resistant portfolios. And unfortunately, a lot of times what we see is people create these portfolios, even advisors, create these portfolios that are not truly diversified because we have no idea what's really in your portfolio. Take your 401k plan as an example. Almost all 401k plans make it mandatory for you to use mutual funds underneath that 401k plan. Now, mutual funds had a place in a time, but unfortunately, they're still a very prevalent type of investment. And we're going to talk more about this from a tax standpoint with taxes in retirement. But one of the deficiencies of mutual funds is that they're not transparent. Meaning, take a look at your 401k plan. You might have one of those life cycle funds, or you might have created your own portfolio based on the allotted mutual funds that they offer you underneath the plan. So let's say you have a life cycle fund, or you created your own, you have 10 different mutual funds. What is it that you actually own? Do you own AT&T? Do you own Tesla? Do you own Amazon? If you own Amazon this morning, are you going to own Amazon tonight? You can't see that, so it's really difficult to create a truly diversified portfolio. So going back to gold, it's important to create a truly diversified portfolio, to have a recession-resistant portfolio. What I mean by that is when the markets drop by 30%, if you're truly diversified, your portfolio shouldn't drop by 30%. Gold can be a good diversifier. If you want to use 5% or 7% of your portfolio and position it into gold or precious metals, that can work. The correlation between gold and the S&P 500 and the Dow is different. What I mean by that is when the markets zig, gold typically zags. Not always, but most of the time, historically speaking. So that can be a good diversifier. You just don't want to be overweighted. And one of the most important aspects of owning something like gold is how do you actually own it? Because there's three main ways that you can own it. You can own the tangible, the physical gold, which is one way to do it, but you want to keep that safe, locked up in a safe somewhere where not very many people know about it. Or you can own it through a kind of a brokerage house where they're going to charge you insurance, they're going to charge you a custodial fee. It's an expensive way to own gold. Or you can own it through an ETF or mutual fund platform. Typically, I would recommend owning it through an ETF platform because it's the least expensive, easiest way to own it. It's the most liquid way to own gold as well. Gold can be a diversifier. Historically speaking, from a return standpoint, if we go all the way back to August of 1971, gold has earned 7.4% on average return. The S&P 500 in comparison, 7.3%. So actually a little bit more than the S&P 500 without dividends. So that's apples to apples, because the gold does not pay a dividend, the S&P 500 does. So if we add the dividend into the S&P 500 yield, the S&P 500 does beat gold handedly. But again, it's a diversifier. Not all asset classes are going to perform the same way in the same market condition. That's a good thing. That's what you want when you're trying to create a diversified portfolio. Let's talk about taxes in retirement. One of the number one wealth eroding factors when it comes to your retirement is taxation. And there's three main different types of accounts from a tax standpoint. There's the pre-tax account, which we're all very familiar with. Your 401k plan, if you put money into it on a pre-tax nature, you're not taxed on it until you actually take it out many years down the road. That's the most common type of tax shelter. The other one is the Roth. You might have the Roth available underneath your 401k plan. You're taxed on the monies you put into it, and then it grows tax-free forever. You take it out, and you don't have to pay taxes, federal taxes on any of that growth. And then we have this third type of an account, and we call that the taxable account. It could be just a regular brokerage account. So let's say you own AT&T in this taxable account. AT&T pays a dividend, let's call it 4%. Each year you pay taxes on that dividend that you receive. If you sell shares of AT&T, you have a capital gain or capital loss. If it's a capital gain, you pay taxes on that capital gain, right? You're paying taxes on the dividends and the capital gains realized each and every year, so it does not grow tax deferred. A lot of people have money underneath these taxable accounts. That's a good thing because it creates tax diversification within your overall portfolio. Now it's how to use this taxable account in this down type of market. Again, the most prevalent type of investment that people use are mutual funds. Mutual funds are inefficient from a tax standpoint, and that's the demonstration that I want to go through, and then I'll give you some action items of how you can actually alleviate that tax inefficiencies right now in a down market. But first, let's go through the concept of how mutual funds work and why they might be more inefficient from a tax standpoint. And that's what we have right here for you. So this is a real mutual fund. It's a Vanguard International Growth Mutual Fund. Not picking on Vanguard. Vanguard is an excellent company. We love Vanguard. All mutual funds have the same tendency and work the same way as what we're talking about right here. But what happens is when you own this Vanguard mutual fund, the mutual fund underneath of it owns different stocks. And the benefit of owning the mutual fund is you don't have to research today whether or not you want to buy more Spotify or whether or not you want to sell Spotify. You don't have to do that research. Vanguard is doing that research. They have a professional management team that's doing the research and making the buy and sell decisions. Those are the transactions. That's a good thing. Except for if today Vanguard says, let's sell Spotify, let's sell Amazon, let's sell Ferrari, and this is really what happens. Let's go back just a couple years ago. 2018 was kind of a wild year, not quite as wild as this year, but it was still a wild year. Remember, we had a correction in February of 18. And then fourth quarter, the S&P 500 was down 13%. December alone, it was down over 9%. So it's kind of a wild year. Let's say that you bought this mutual fund in March of 2018, right after that first correction. Right after that first correction, you say, okay, we're set. We had a kind of a pullback. The market's going to do well for a while. Get into this mutual fund. You put $10,000 into it. And now over the course of the year, Vanguard, the research team, is deciding whether or not they're buying and selling. Now remember what happened prior to 2018. Really, since 2009 to 2018, we went on a 10-year bull market run that was pretty much unprecedented, historically speaking, in the S&P 500. So now think about what the Vanguard Mutual Fund management team is thinking. They have all of these holdings underneath of here that have done extremely well over the last 10 years. Their models, their predictive models, are saying, well, the markets might be in for a bumpy ride. Let's start to take some profits. Let's start to take some of the profits off the table. From 2009 to 2018, Tesla had fared really well. Ferrari had fared really well. Amazon had fared really well. So the Vanguard research team is saying, let's take some of those profits. That's why they're selling Spotify. That's why they're selling shares of Amazon and Ferrari. And what the fund is doing is they are realizing capital gains. They're realizing the capital gains. You bought into this fund in March, so you did not participate in all those gains over the last 10 years, but now you're a shareholder in this mutual fund, which means you will participate on those capital gains if you're still a shareholder at the end of the year when they declare those capital gains. And let's see what that looks like. Again, you invested $10,000 March of 18 into this mutual fund. Now it's the end of 2018, and because of the transactions, the buys and sells of the research team, you experienced your share of the capital gains is $1,000. Now, obviously, the mutual fund had millions of dollars of capital gains, but you're a part owner and you have a number of shares that exposed you to $1,000 of capital gain within the mutual fund. Now, your actual market value, remember, you invested $10,000, but 2018 was kind of a rocky year, so the Vanguard mutual fund's value actually went down, which means your $10,000 investment is no longer worth $10,000, it's worth $8,500. So you actually lost money over this time frame, except for at the end of the year, when you receive your 1099, you receive a 1099 for $1,000 capital gain because of the capital gains that you experienced, that the mutual fund experienced underneath of it. So let's take this one step further. In that scenario, you owned this mutual fund throughout the end of the year. You actually lost value. You didn't sell the mutual fund at all, so you didn't incur that transaction. You didn't make that choice. You just made the choice to buy. You didn't sell it, but you still had to pay $1,000 capital gain because you had that ownership and you shared in the capital gains that the mutual fund received. But let's say now, this is later. This is February of 2019. You said enough with this Vanguard fund. You want to sell this Vanguard fund. You sold the Vanguard fund and you had a $1,500 gain. You experienced a $1,000 loss, which means that you have a total net gain of $500. Now, in this scenario, this is one of the reasons that mutual funds are tax inefficient. Some of the most tax inefficient vehicles that you can use, because a lot of people in 2018, they did actually lose money on their investment, but they still had to pay taxes. So one of the solutions that you can incorporate right now or consider. Some people this doesn't work for. Some people they're not in this situation because their accounts are not in this situation. But this is something that we're doing right now for families that we work with in this type of situation. Is they've held these mutual funds in taxable accounts now for a few years, but because of this decline in the market, if they sold those mutual funds, they wouldn't realize a capital gain. They would actually have a small loss, or in some cases break even. So basically they can exchange the mutual funds, take that money and transition it to a like risk other type of investment like an ETF. So we're not talking about changing risk categories, meaning the important part here is when this market does rebound, they're still going to be able to participate in the rebound. They're just participating in that rebound in a more tax efficient vehicle, like an ETS. 2018, there was a study that was conducted, 62% of mutual funds paid a capital gain. 62% of mutual funds paid a capital gain compared to 5% of ETFs in the same year. So ETFs are more tax efficient. If you can eliminate the mutual funds that make sense from a tax standpoint now when the market's down, shift it over to a like risk ETF and ride that market on the way back up, then from a tax standpoint, you should be a lot happier with the outcome. Now, before you make tax changes, it's good to consult with your tax professional or retirement planner. Make sure that that strategy is going to work for you. This goes back to your customized plan. Everybody's plan should be different. Everybody's situation is different. So make sure that within your plan, a component of that plan is your tax plan. And then within that tax plan, you'll identify strategies like this. You'll identify strategies like, does it make sense to do Roth conversions when the market's down? And those strategies are going to either work for you based on your situation, or you know that they're not going to work. But either way, it's an analysis to determine what strategies, what things can you implement right now, even though the market's down. Because everybody's telling you on the news, don't do anything, don't do anything. Just wait, close your eyes, wake up 2 years from now, or at the end of the year, and the market's going to be better. There are, for many people, strategies you can implement to put yourself in a better position when this market goes up. The one thing about the market, if there's one thing that we know about the market, is it's going to go up and it's going to go down. And there's nothing you can do about it. There's nothing I can do about it. There's nothing anybody can do about it. But there are things that you can implement to take advantage, whether the market is up or whether the market's down. It's a matter of evaluating it, make sure you have a plan in place to make sure you're getting the best out of whatever situation is that none of us can really control. I hope that helps. What we're going to do is provide, you're going to have a link or some kind of thing on your screen that's going to enable you to sign up for a 15-minute retirement checkup call with me. Merkle Retirement Planning, we specialize in the retirement planning aspect, which means we work with people who are within 10 years of retiring or already retired. So if you're within 10 years of retiring or already retired, you want a retirement checkup, we don't charge you for this. It's a 15-minute phone call with me to say, what might you be able to do to help your situation right now when the market's down? Are there strategies like this you should be considering or looking at? And then maybe I can give you some action steps going forward. If you're 30 years old, 40 years old, well out from 10 years of retiring, maybe we can refer you to an accumulation specialist. I think that's an important takeaway as well. Not all advisors are the same. There's advisors that focus on the accumulation phase. When you're younger, you're buying a house, you're raising kids, trying to put your kids through college. And then there's a few of us that focus on the retirement planning phase. When you're a few years away from retirement, you need to focus on where's the income going to come from. You're focusing on tax planning strategies, you're focusing on Social Security strategies, legacy planning strategies. So there's two different types of advisors. If you're within 10 years of retirement or already retired, that's our specialty. If not, that's okay. We'll still try to help, and we'll try to refer you to somebody who does specialize in the phase of life that you're in. I wish you all a great week. It was great to be here again. I'll see you next week on the Merkle Market Update, Tuesday, 9 a.m. Have a good day.